Hi, this is Charles Gaba of ACAsignups.net. In part 1 of my risk pool video, I went over the basics of how healthcare risk pools work and why separating out people with really expensive medical conditions from the rest of the population is a terrible idea, economically, structurally, and morally. In part 2, I'm going to explain more specifically why Donald Trump's scheme to remove almost all restrictions on short-term and association healthcare plans will take the single largest existing problem with the individual health insurance market under the ACA and make it much, much worse. Again, before the ACA, unlike employer insurance, Medicare, Medicaid, or CHIP, where people are generally enrolled based on their employment status, age, or income, in the individual market, insurance carriers were allowed to cherry-pick their enrollees and set their premiums based on their medical history, medical conditions, gender, and so on. The ACA changed the rules on all of that. Again, let's assume the entire individual market population is boiled down to just 100 people, with 10 of them eating up 2/3 of total medical expenses. The idea of the ACA was to push all 10 of these folks back into the same risk pool as the other 90 to spread the risk out across the entire population, which I should note is the whole idea behind insurance in the first place, pooling risk. Your auto insurance premiums go to pay for someone else's car accident today, while the premiums paid by others go to repair your car if it crashes next month. Of course, doing this meant that costs for the other 90% did indeed increase. But the thing is, just as they were supposed to do in the pre-ACA high-risk pools, but which most states failed at miserably, the government still steps in to provide financial assistance for those who need it. It's just done in a different way. First of all, the money comes from the federal government instead of the states, which is important because states have to balance their budgets no matter what, while the federal government has more leeway. Second, instead of the government using the "how sick are you" yardstick as the basis for where the subsidies go, they switched to "how much do you earn and how much does the policy cost" as the main formula framework. Very low-income people would go into Medicaid, while low to middle-class folks would receive financial assistance on a sliding income scale. Now, it hasn't quite worked out as intended for a variety of reasons. Some of this was due to the types of mistakes which are typical of a 1.0 version of any major piece of legislation. Some of it was due to court rulings, like the Supreme Court decision, which left Medicaid expansion up to the states. Some of it was due to real errors in execution by the Obama administration, and a lot of this was due to earlier types of deliberate sabotage, which I've written a lot about in the past, but won't get into right now. One of the original problems, which I've written a lot about, was a simple but critical flaw in the ACA's tax credit formula, the subsidy cliff. Instead of the subsidies tapering off gradually as you go up the income scale, they do so up to a point, but then cut off instantly the moment your income hits 400% of the federal poverty line, which is around $48,000 for a single adult, or $98,000 per year for a family of 4. That's what most unsubsidized individual market enrollees are complaining about the most with the individual market today. Still, at the end of the day, one prevailing philosophy has taken hold among the public since the ACA was first passed. The majority of the public now solidly opposes allowing insurance companies to deny coverage to or discriminate against people based on their medical condition, and most feel that yes, health insurance policies should indeed cover the full range of typical healthcare services. In other words, most people strongly support the blue leg of the ACA's three-legged stool. And since not allowing insurers to cherry-pick their enrollees naturally causes overall premiums to rise substantially as a result, people also want to receive financial assistance to help pay for that blue leg. That's the tax credits and cost-sharing reduction subsidies. They love the blue leg and are mostly supportive of the green leg. This means that it's only the red leg of the stool which people really hate. That's the individual mandate penalty, which was put into place to make sure that as many of the healthy 50% of the population as possible stay in the same risk pool in order to keep premiums from spiraling out of control even further. Of course, last October, Donald Trump eliminated cost-sharing reduction reimbursement payments to the carriers. But thanks to some clever maneuvering by the ACA exchange boards, state insurance commissioners, and the carriers themselves, they came up with a clever workaround called silver loading, which mostly mitigated that damage and even enhanced the subsidies for a lot of people. In December, however, congressional Republicans eliminated the individual mandate penalty as well, which means that, again, according to a recent Kaiser survey, about 7% of these folks will definitely drop their coverage next year as a result, and another 3% weren't sure whether they would or not. Let's say a total of 9%, just about all of whom are likely to be part of the currently healthy, low-risk half of the population, drop their coverage due to the mandate being repealed alone. What would this do to premiums for the other 91% who stay? Remember, in our example, the total cost of caring for all 100 people is an even $1 million. But the 9 people who drop out only cost about $600 apiece. So eliminating them from the risk pool only saves about $5,400, or 0.5% of the $1 million total. That means that you now have 91 people costing about $994,000 to cover, or an average of over $10,900 apiece. Yes, that's right, you just raised premiums 9% on everyone who sticks around. Of course, estimates on the actual math of this vary widely in the real world. But as it happens, this is pretty close to the Congressional Budget Office's projection, so that means the CBO projects that congressional Republicans repealing the individual mandate alone will cost millions of middle-class people, that is, those who earn too much to receive subsidies, an extra $720 in 2019. But wait, there's more. In Part 1, I broke out the roughly 50 million Americans who aren't covered by either employer-based or government-based insurance, which includes around 16 million on the ACA individual market, about 29 million not covered at all, and roughly 5 or possibly 6 million people enrolled in a sort of grab bag of non-ACA compliant individual plans. This is the heart of Trump's recent executive order. This mismatch is broken into 7 types of non-ACA compliant policies for people not covered by their employer, Medicare, Medicaid, CHIP, or other types of public health programs. They're referred to as grandfathered, grandmothered, or transitional, student, sharing ministries, Farm Bureau, short-term, and association plans. By the way, I want to give a shout out to my friend and colleague Louise Norris for helping me track down some of the data for these. Grandfathered plans are individual market plans that people enrolled in before the ACA was passed in 2010. Enrollment was frozen at that point, and the number of people enrolled in them has been dwindling ever since. Grandmothered plans, also known as transitional plans, are non-ACA compliant plans people enrolled in between 2010 and late 2013. They're only available in about 2/3 of the states, and again, enrollment was locked in and has dwindled over the past 5 years. Then there's university-offered student plans. These are fully ACA compliant, but with a few special allowances. There's around 1 million people enrolled in these today. Health sharing ministries are generally plans offered by religious organizations, usually Christian. They're allowed under the ACA within certain parameters. The main catch is that you have to agree to live your life by their religious, ethical, or moral standards, which often includes things like no drinking, no drugs, no smoking, no extramarital sex, and often having to accept Jesus as your savior. As of 2016, there were supposedly 625,000 people enrolled in these, although this number has supposedly reached nearly 1 million more recently. Oh yeah, the other big catch? Sharing ministry plans aren't legally defined as health insurance and thus aren't considered subject to ACA or other insurance regulation. Then there's Farm Bureau plans. These, like ministry plans, aren't legally considered insurance in the first place, which means that not only aren't they subject to ACA regulations, but they don't even fall under the control of the state insurance commissioner. Tennessee is the only state I know of which has allowed these plans to be widely sold, but Iowa has more recently opened the floodgates on them as well. Now we get to short-term limited duration plans, or STPs. These are exactly what you'd think. They're currently only available for up to 3 months at a time and can't be renewed until the following year. These are designed specifically as a stopgap coverage for people undergoing certain life transitions only. One report from eHealth suggests that there's only around 200,000 people at most enrolled in STPs at the moment. And finally, there's association health plans, or AHPs. These are subject to ACA regulations and are controlled within each state, but they're also currently categorized under the small group market, which means that they're still not part of the individual market risk pool. Add all of these types of non-ACA compliant plans up, and I estimate there's between 5 to 6 million people enrolled in them collectively today. It's important to understand that of all 7, only student and association plans currently include the protections and requirements of ACA policies. And more importantly, none of them, including student or association plans, are part of the same risk pool as ACA policies. Each of them has their own separate risk pool. This is really, really important because a few months ago, Donald Trump announced an executive order which would basically yank away the restrictions on short-term and association plans, leaving the landscape wide open for junk policies to flood the market. And worse yet, with the mandate penalty having been repealed, there's no longer any obvious incentive for people to avoid them as long as they're healthy. To reiterate, the reason these plans are so inexpensive up front is precisely because they don't include the requirements of ACA policies, especially in the case of short-term plans. They can cherry-pick enrollees, kick you out if they decide you're going to be too expensive, deny coverage of pretty much whatever treatments they want, charge you up the wazoo if they want to, and so on. Of course, the GOP has repealed the mandate penalty already, and non-ACA plans don't receive any financial assistance, nor are they subject to any price gouging regulation. So Trump's vision is basically right back to the ugly pre-ACA days, with the stool seat dropping right back down to the floor. How would this impact our risk pool? Well, according to the same Kaiser study I mentioned earlier, if short-term plans explode next year the way Donald Trump is hoping they will, 12% of current ACA enrollees would move to them, with another 4% presumably dropping coverage altogether or not being sure what they'd do. Let's split the difference and say that 14 of our 100 enrollees drop out. It's likely that nearly all 14 of them would still be among the bottom 50% in cost, which means that you're now saving $8,400 out of the $1 million total, leaving the remaining 86 enrollees with average costs of $11,500. Yes, the combination of repealing the mandate and expanding short-term plans means that you just raised premiums on the rest of the ACA market by another 15%. But wait, there's more. What happens to those 14% who did drop their ACA plans and move to short-term plans, association, and other non-ACA compliant plans which don't have the protections that I've discussed? Well, as long as they're healthy, they're fine. But what happens once they're diagnosed with one of those expensive ailments which isn't covered by those plans? For that matter, what happens to those who earn too much to receive subsidies, but have a pre-existing condition which gets them denied coverage on one of the short-term or association plans? These folks are, yet again, basically screwed. If they can survive until the next open enrollment period, they can enroll in an ACA policy. But if they earn more than 400% of the poverty line, they have to pay full price, which they most likely won't be able to afford. That's the whole reason many of them dropped out in the first place, remember? This problem will be made even worse by the association plan portion of Trump's executive order, and the state of Iowa has decided to push the throttle all the way on this to the limit by just saying screw it and allowing full-on Farm Bureau junk plans without any ACA protections or regulations whatsoever by officially declaring that they aren't legally defined as health insurance at all and therefore can't be regulated by the state insurance commissioner. But it's actually worse than that, because the price increase itself will likely cause even more healthy people to drop out of the ACA compliant market, again leaving those who are sick but earn too much to receive financial assistance to fall through the cracks. Those folks will have no choice but to drop any type of coverage altogether, putting them right back in the same dire situation they were before the ACA went into effect in the first place. The obvious solution to this problem, at least in the immediate future, would be to go completely the other way. 1. Remove the 400% federal poverty line income cap on subsidies. 2. Beef up the subsidy formula for both premiums and cost-sharing reduction assistance. 3. Restrict short-term plans and association plans. And, as much as people may hate hearing this, 4. Bring back the individual mandate, the repeal of which, I should note, Trump's former HHS Secretary, Tom Price, just admitted will cause further significant premium hikes and market destabilization. There's a lot of other important fixes, but the first two I mentioned would dramatically lower the pressure middle-class people are facing to take up the third, which in turn would reduce the number of people being hit by the fourth. Anyway, that's it for now. Again, I'm Charles Gaba of ACAsignups.net. If you'd like to support my work on an ongoing basis, please become a patron at patreon.com/CharlesGaba. Or if you'd like to make a one-time donation, you can do so at gofundme.com/ACAsignups. Thanks.